Hello, I'm Anastasia Moroso, and this is Beyond 60/40. On this show, we do a deep dive into the alternative investment space, share industry leader insights, and discuss the latest innovations in technology. Today, as always, we'll kick off the show with my Market Pulse snapshot, and I'll share the one thing that caught my attention in private markets this week. Next, Brian Reuter, partner at Permira, joins me in the studio virtually to talk about tech investing. Then, in our Spotlight series, managing partner at Requisite Capital Management, Bryn Talkington, lays out her approach to helping clients access alternatives. Let's start breaking this down. In today's Market Pulse snapshot, the one thing I'm focused on in private markets is how private equity and venture capital firms are investing in the growing megatrend of artificial intelligence. The first thing to note is both private equity and VC funds have become increasingly active in this space, investing significant amounts of capital into AI-related companies. For example, in 2023 alone, $105 billion was invested across the entire AI vertical, and a record $29 billion of that was invested across the emerging generative AI space. That's up 3 times from the previous year. For context, the overall private equity and VC deal environment has been relatively subdued over the past couple of years. So this inflow of capital into AI really shows the eagerness of GPs to step in and capitalize on this important theme. Now, given this focus on AI, companies in the space have been able to command a valuation premium. The overall median pre-money valuation for companies within the AI vertical increased about 6% in 2023 to record levels, with pre-seed and early stage seeing the largest increases. Now, broader VC valuations in the meantime have remained far below their 2021 and 2022 peaks. And in fact, the valuations for early stage AI companies were close to 20% higher than non-AI startups in 2023. This really further underscores the valuation premium those AI companies are commanding. So how do VCs and PE firms exactly invest in AI? Well, the investment approach differs among them. But venture capital, for example, has largely focused on pre-seed and early stage AI startups. And those collectively account for 2/3 of all the completed VC deals over the past 3 years. And of all the completed deals within the AI sector, VCs are focused on vertical applications or companies that integrate AI technologies to optimize some part of their product. Now, increasingly, horizontal platforms are also attracting VC attention, and they include companies focused on core AI foundational models that can empower end users to build and deploy algorithms across various use cases. So while VCs prefer to invest in early-stage startups with innovative AI solutions, PE firms are deploying a more picks and shovel approach, leading into first and second derivative plays of AI rather than investing directly in those startups because they command quite significant premium valuations. So this investment approach includes areas such as hyperscale data centers, for example, which can ramp up or down capacity based on demand, or they may focus on cybersecurity companies that can help safeguard against AI, or companies preventing computing hardware from overheating, which happens with a lot of AI applications. Now, private equity firms may also focus on more established companies that are integrating AI into their operations. And firms like Permira, for example, may invest in companies that leverage Gen AI to drive growth and focus on operational transformation, where using AI can help optimize workflows and enhance efficiency and hopefully profitability in the company. So bottom line, AI is a dominant theme for VCs and private equity fund managers. And VC funds are helping to incubate the next batch of AI leaders, while private equity managers are committed to creating value by boosting company productivity thanks to AI and automation. Together, these managers offer investors another very important avenue to invest in the AI theme beyond the public markets. And that's your one thing to know in private markets this week. But we are going to pick up this very conversation in our next segment with the co-head of tech investing at Permira. Check it out. My My first guest today is Brian Reuter, partner at Permira, who helped build and lead the tech effort at the company. Permira was founded in 1985 and has approximately 80 billion euros of committed capital and specializes in transformational growth investing at scale across buyout, growth equity, and credit funds. On the private equity side, Permira applies a thematic investment approach across 4 core sectors: technology, consumer, healthcare, and services. And today, we're thrilled to talk about tech investing. So for that conversation, thank you so much, Brian, for joining me today. I know you're virtually in San Francisco, but great to see you here today.
My pleasure. Good to see you, Anastasia.
Really excited to have this conversation, but to start off, just tell us a little bit about Permira, and I know you've built the tech effort there, and so what's the approach to tech investing that you take?
As you mentioned, we've been around since the mid-1980s, and during that entire time, we've been really backing transformational growth at scale across those 4 core sectors. The kinds of businesses that we're looking for, either in our buyout strategy or our growth equity strategy, are market-leading businesses where there's the chance to grow at significantly faster than GDP growth rates and with outstanding unit economics. So we believe in helping companies find their maximum efficient growth rate, which is very different from most of private equity, which tends to be about helping companies find their maximum EBITDA margin.
I really like that, maximum efficient growth rate. But speaking of technology and growth, we can't talk about it without talking about artificial intelligence. So that's what everybody wants to know, is how are you approaching investing in AI?
Yeah, so I should say in context, I think this current wave of AI, which is by no means new AI, because AI has been around since the last century, but the current instantiation of it is one of the most exciting trends I've seen in my career. And much more than, for example, crypto, where we thought just that was mostly a solution in search of a problem. In this case, there are very real world applications of the current set of tools and technologies that are just at the cusp of really having a significant impact on daily life, on real businesses as we see them. Our approach is multifold. So of course, in our technology, in our consumer digital businesses, we're using these tools both for productivity kind of enhancements, but also building these tools into our core products. So 100% of our portfolio are using AI, by the way, with an average of 10 projects per company, putting them into the products of the company, but also using them for efficiency, for example, in their contact center or in how they're managing their software developers. There's never been a more interesting time, we think, to be a multi-sector investor with a core technology capability, because a lot of the areas where AI is going to have the best and most interesting impact are actually businesses which are not classically AI companies and not even really technology companies. So they're going to happen in the healthcare supply chain. They're going to happen in services companies. And we're able to take some of that core technology, interest and expertise and bring it to some of those businesses as well.
So kind of 2 types of approaches, which is infusing AI into some of the businesses that you might be buying out and infusing productivity, and then also finding opportunities across sectors. But on the productivity side, I mean, what kind of boost to productivity, what kind of lift to profitability might you see in some of these companies that you work with?
Across our software development teams, we're seeing pretty consistently already a 20% uplift in productivity across that universe, with some variability through that. And if you talk to most big companies that we see, they would say it can get to 30% plus. So that's meaningful in the context of the tooling that's still in actually pretty early phase. In the near term, sure, that's actually a pretty interesting cost savings opportunity. It's also, the company can produce more with the same amount of development resources, now. So it creates the potential for actually a lot more acceleration of the pace of innovation.
I mean, 20-30% lift in productivity, that's definitely meaningful. That moves the needle. But Brian, my last question for you is, obviously you've been a tech investor for a long time, specifically in private markets, but a lot of our clients, a lot of our audience has been accustomed to investing in technology in public markets. And let's face it, there's a lot of stocks out there to pick from. But what do you say to somebody who's entertaining the idea of maybe I should do my tech investing also in private markets? What do you say to that?
Yeah, I think there's a lot of really good reasons why you would want to take a look at investing through the private markets, and really through a manager who's going to be able to get you that access in the private markets. So one reason is the quality of the kind of diligence that we're able to do in a private context is just different from what you can get in the public market. Public market disclosure is a wonderful thing. I mean, reading a 10K, you get a lot of information out of that, but it's a very small share of what the information we get before we acquire a business. We get all of the inside information about how those businesses operate before we make that investment. And that can make a big difference in terms of making intelligent decisions about, for example, what's going to be the right winning product in a market over time. Probably the better reason, though, even to do it is that companies are staying private longer. And when you have these innovation waves, there's a lot of capital in those private markets too. If you want to really be able to get exposure to in your portfolio, the real growth, hyper growth, and just steady growth, more and more of that is happening in the private context. Companies are bigger when they go public, so they've gotten through that hyper growth phase increasingly. And if you want to get access to even a trend like AI, cloud computing, and the like, more and more of that action is happening in the private markets.
That's right, indeed. And of course, there's lots of statistics supporting that. And, for example, for artificial intelligence itself, there's 65 times as many private AI companies globally as their public ones. So a lot more to choose from. And I'm sure we're going to see some phenomenal winners come out of this space in the coming maybe 12 months or at least the next 5 years. So Brian, with that, this has been a fantastic conversation. Thank you so much for joining your expertise around technology with us. Thank you so much for letting us learn more about Permira. And Brian, thanks so much for your time today.
Thanks for having me.
Today, on our Spotlight series, I've asked my colleague and CNBC contributor, Bryn Talkington of Requisite Capital Management, to join me here in the studio at iCapital. With a career in financial services industry spanning 20 plus years, Bryn is truly experienced in all facets of asset management with a focus on capital markets, alternatives, and investor behavior. Requisite oversees over $1.6 billion in assets and was founded in 2017. Bryn, thanks so much for joining me today.
Thank you, Anastasia. Very excited to be here.
It's great to have you here because obviously we've had a chance to do this together on CNBC, but we get to hear from you not only about public markets, but also alternatives and private markets today. But let's start a little bit with the story of Requisite because you founded in 2017, so fairly recently, but how did it come about and how is it going?
Yeah, so it was going great. My partner, Doug John, he was a private wealth advisor for his whole career. And we met at UBS. I was on the asset management side. And he approached me about starting our own firm. And we spent a lot of time putting it together. And then in 2017, we left UBS to start Requisite. And it's been hard work and just so rewarding to be able to create a firm really built around what we feel are the best type of investments and strategies for our clients.
You've done an incredible job and keep growing it, which is amazing. But when we turn on CNBC and we hear Bryn on a halftime report or closing bell, you might be talking about individual stocks or individual ETFs. But what a lot of people may not know is that for a big portion of your practice, you do focus on alternatives. And so tell us the why, the how much of alternatives do you use in your practice?
Since inception, we've actually allocated to 80 different funds and committed close to $1 billion of capital in the last 7 years. So it's definitely bread and butter to our business. We actually don't call them alternative investments. When it comes to a private client especially, really you have liquid and illiquid. Your liquid, when it comes down to it, are stocks, bonds, and cash. Your illiquid are your illiquid investments that we would call financial jargon, private equity, private credit, venture, etc. So we want to start there with educating, at the end of the day, how much of illiquidity do you want to tie up with the capital? And it really starts with what are we trying to solve for the individual client or family.
How has the evolution occurred with your clients? Were they always open to using illiquid assets in their portfolios? How have they embraced that?
There's always a really big education arc. And so you want to understand, first of all, someone's experience. Have they been experienced in having illiquidity in private investments? We would rather not tie up any capital. We would rather just say, sit through the volatility of equities, earn the return of cash right now, which is wonderful. But the reality is that's not practical because we all know that volatility in equities is actually the biggest hindrance to earning that long-term return. And so I think when people create this wealth, they want to, they say concentration creates wealth.
Yeah.
Diversification preserves it.
Right. And so, it's really starting with the goal in mind. What is it that you're trying to solve for the client, whether it's the potential for higher returns, whether it's the potential for higher income or diversification. So it sounds like once you explain that makes taking that illiquidity risk a lot more understandable.
We're solving for a solution. We don't come in ever and say we want 20% private real estate, 20% PE, 10% VC, because once again, these are illiquid investments, and you need to be intentional around assets that are going to be illiquid.
All right. Well, let's get a little bit specific, and maybe let's talk about some of the jargon in private equity and private credit and real estate. We often hear you talk about individual stocks, but where right now do you think we should be looking for opportunities in alternatives in private markets?
Well, after the 2008 financial crisis, the big banks have just continued with Dodd-Frank, Basel III, just to be regulated like they were prior to the deregulation that started in the 70s and 80s. And I think that regulation is really helping specifically more the private credit side. There is a big opportunity in real estate, but we don't want to have real estate investments with debt. So we look for private credit managers that are buying real estate for cash or close to cash with LP capital. And so because it is a math equation in real estate, we think there's just going to be wonderful opportunities as the banks are looking to offload so much real estate that they have on their balance sheets.
Right, and when you think about buying real estate using debt, it just doesn't make sense now, does it? Given where the cap rates are and given what you might have to pay on your loans.
It really is tough to pencil out from the old structure of buying real estate with debt. You're banking on actually interest rates coming down for that to work. So we want more asymmetrical risk on the positive side.
Well, we know how banking on lower rates has turned out so far this year. Okay, Bryn, my last question for you. This morning we were on a panel together and we were talking about private client allocations to alternatives. And I mentioned that maybe 30% of advisors do it. And if they do it, something like 3 to 5% is what the allocation tends to be. I assume you're much higher than that in your business. But what is the disconnect in your mind, or what does it take to kind of move the needle to go from 3 or 5% in portfolios to maybe closer to 20?
I think first of all, you need to be intentional if you're going to invest in the alternatives. Know the manager, know why you're investing, and understand that most people, especially higher net worth and ultra high net worth clients, do want an income stream, do want a return stream, and you are just very limited in the opportunities you have in public markets. And so we still think there's a tremendous opportunity across the less liquid, the illiquid part, but I think advisors need to be intentional. I think if you're going to do 3 to 5%, you should just do 0. Right? Because, we're very comfortable going 30, 40, 50%, but that's client by client, understanding what are they solving for. And I think that that's a really key question that advisors should be asking their clients. Then that naturally can lead to having other things in the portfolio outside of stocks, bonds, and cash.
Right. If you're going to do 3, maybe just do 0, but 30, 40, or 50% allocation is what you tend to have across your practice. Bryn, this has been fantastic. Thanks so much for joining me today and kind of shedding the light, not only what you see in public markets, but also private markets. Thanks for your advice and helping us get there.
Thank you. It's fun not to talk stocks.
Thanks, Bryn.
Thank you.
And don't forget, we want to hear from you. Send us an email to yourquestion@icapitalnetwork.com and let us know what questions are at the forefront for you and your clients. I'm Anastasia Amoroso, and thank you for joining us today. We'll see you next time on Beyond 60/40.